Is 2023 going to be a better year for markets? Considering the predictions for the year ahead. Christmas is coming and the financial world analysts are publishing their predictions for the year ahead. A lot of the research produced at this time of year is genuinely interesting. With financial markets facing unprecedented crisis, it's important to take a hard look at economic realities since analysts agree markets face serious headwinds. There are key issues that suggesting that there may be problems for asset markets in 2023, with the understanding that in such uncertain environment, there are no clear choices for investors. Times were difficult for the markets in 2022 and at the same time the year ahead promises to be much more positive for markets, with the bullish prediction by a leading financial advisor following a rough year for markets triggered by headwinds, which included Russia's war in Ukraine. From inflation to energy shortages and general instability, markets are set for an unstable year ahead. The indications are such that we expect more favorable conditions, and increasingly so, as we move through 2023. After a 13 years period during which prices of shares on the stock market are generally rising, financial markets went into bear territory in 2022 in the middle of increasing global grim environment changing quickly and unpredictably, with energy being in high demand and short supply. Prices are high and rising and emerging economies are coming out of the pandemic in unstable condition. Although the International Monetary Fund has forecast that 1/3 of the world's economy will be in recession in 2023, the landscape is already looking brighter for the year ahead. We expect some key market, macro and policy shifts that will provide a significantly more positive outlook for investors. Inflation is unlikely to slow anytime soon but is likely to peak in most major economies. Since consumers and businesses have no alternative but to pay the higher costs, there is limited scope to ease upward pressure, particularly with many governments subsidizing consumer purchases. Past inflationary cycles have ended when prices rose to a point of unaffordability, triggering a collapse in demand. This process is straightforward when it comes to discretionary purchases but problematic when necessities such as energy and food are involved. As inflation begins a return to target, the cost of living will drop for consumers and central banks will ease their feet off the economic brakes, going easier on interest rate hikes before winding down. Without dramatic changes in the geopolitical and economic landscape, fossil fuel shortages look likely to persist through next winter. Russian supplies have been slashed by sanctions related to the war in Ukraine, while Europe's energy architecture suffered a damage when a part of the Nord Stream 1 pipeline was destroyed. New infrastructure takes time and money to build. Fortunately, record growth in renewables and electric vehicles has helped. But there are limits. Renewables require hard-to-source elements such as lithium and aluminium. Nuclear would ease the pressure, but new plants take years to bring online and garnering public support can be hard. The digitalization of business models continues fast, increasing efficiency and productivity, lower operational costs, improve customer experience, improve competitive advantage, and improve speed and outcomes of decision-making. Supply chain shocks from the pandemic and Russia's invasion of Ukraine have increased an appetite in major economies to restore production. While this could prove a long-term boon to domestic growth, restoring takes investment, time and the availability of skilled labor. In the short to medium term, the restoring of jobs from low-cost offshore locations will feed inflation in high-income countries as it pushes up wages for skilled workers and cuts corporate profit margins. Worried about a global recession, investors have got into the dollar looking for a safe haven. This has negatively impacted both developed and emerging markets globally, fueling inflation and raising the cost of imported goods. Bitcoin is expected to surge in 2023. Meanwhile, already strong demand will only increase once China emerges from its COVID slowdown. but it is likely that investors will be seeking to increase exposure to growth stocks towards the end of 2023 as cost of living eases and global growth picks up pace. Hopefully, transition is being accelerated by revolutionary technologies. And while the process isn't new, it is causing troubles for markets as well as society. Markets, after all, thrive on the ability to calculate outcomes. When the very foundation of consumer behavior is undergoing a phase shift, this is increasingly hard to do. Market volatility has lowered market values of some high-quality equities, which can create better long-term investment opportunities and generate higher income for investors. Investors will be currently viewing this backdrop as a buying opportunity to top up their portfolios. Taken together, all these trends point to a period where only the careful and opportunistic investor will come out ahead. So fasten your seatbelts and get ready for the ride. You should take a look at stocks that are likely to be recession resistant. For example, people will still need food, energy and financial services during a downturn. These sectors should do well. Please subscribe to my channel and click the bell to get alerts when a new video is posted. You are welcome to write your comments, questions, or concerns you would like to share.